Greetings and welcome to another edition of the Ad Astra Kansas Money Talk podcast. I'm your host, Joe Blubaugh, and I'm joined today by Mark Johnson of Bob Schwartz Financial. You can find out more about Bob Schwartz Financial on the web at bobschwartzfinancial.com. If you're joining us on YouTube, please give us a thumbs up and subscribe. Click that bell. Make sure you'll know when the next episode is posted. And if you're listening to us on your favorite podcast, we'd love it if you could give us a rating. We would appreciate that. As we've said many times, we talk about anything that's money for Kansans and how they're impacted by whether it's policy or savings or whatever it might be that particular episode. This particular episode really is more generic. It's not necessarily just for Kansans. It's for everybody. We're going to talk a little bit about your paycheck and what's a good way to allocate funds from the paycheck and use it wisely. It's always good to have a budget. It's always good to have a plan when your paycheck comes in, because if not, it can very quickly get spent away.
Yep.
So we're going to take a little bit of time to kind of talk about some good habits when it comes to paycheck spending. So, Mark,
Yep.
Always nice to see you.
Yeah.
Let's talk a little bit about what's probably the most important thing when it comes to allocating the paycheck in maybe prioritized order.
Yeah. So number one priority is, laying the foundation of, what needs to happen right after you get paid is you need to cover your expenses that are going on. So ensure your essential expenses are covered. Your house, your utilities, your groceries, your insurance premiums, Transportation, those are covered first. That's your first goal as soon as you get paid, that you have all those things covered.
And always good to have those budgeted out. So those are expenses that, for the most part, should be fairly steady month to month. Mm-hmm. Always good to have those budgeted, ready to go right off the bat when you get that paycheck. Those are the things that are getting taken care of first.
Yeah, and so having your paycheck go straight to your checking account and understand, $500 of this money that's getting sent to my checking, that is for this month's, liabilities, pretty much what you're spending on. Mm-hmm. Just having that ready to go. So that's priority number one.
Sure. Now, I think it's probably, you could make some argument that maybe this next thing that we're going to talk about, it could be down the list further, maybe further up the list, but we're going to talk about employer matches on retirement savings, because I do agree that is, in my opinion, one of the things that should be higher on the list when it comes to your paycheck.
Yeah. So think of it, it's free money on the table. If your employer offers a 401k match, if they offer a match through your Simple plan, whatever it is, I really think on this, list of how your paycheck should go, that should be up near the top. You're not going to see that money go into your account. You're going to see it go into your
retirement account.
In your retirement, but you're going to see that match too. And it's going to grow, it's going to compound over time. And it's one of probably the best wealth building tool in retirement that, today's retirement system has for us.
So as we're kind of racking and stacking these, in your opinion, it's all those got to do it things first. Yep. Bills, groceries, food, shelter, all those things. Then that match.
Yeah.
As long as you can afford that should be the next thing on your list.
Yeah. And if you can't afford, putting your whole, try to get as close as you can to that match without, putting yourself over the limit. But just being able to participate and being able to get close to that match and having them, match as much as you can handle is a huge benefit.
And it does pay off in the long run. That is for sure.
Yeah.
So as we kind of go down the list, so let's assume that bills are paid for and the match is taken care of. What would you say would be next for folks to prioritize?
Yeah, so you should look at your the things that are happening to you right now. So high interest debt would be the big one. So credit cards, your payday loan, if you have something like that, those are high interest debt. The biggest one obviously is for people is your credit card. You do not want to be paying a high interest credit card debt over multiple months. If you can get rid of that as soon as you can, that's our goal, to make sure you're paying that off every month.
So your recommendation would be pay off the high interest debt as fast as you can. And this is where I think there would be the question is it more important to get that match or more important to pay off that high interest debt? If you're getting 100% match, that's 100% return.
Yep.
And if you're paying 18%, interest on a credit card, that's really high interest, but that's probably fairly close to what people are paying right now.
Yep.
And 100% is greater than 18%.
Yep. Yeah, and I think what some people, people get confused with high interest debt, low interest debt. Think about your high interest debt as those credit cards, those loans for short, the payday, the short time loans that are over 10%. Really, usually is what I'm thinking of. Your mortgage is usually going to be low interest, something below 6-7%. More low interest debt. So when we're talking about high interest debt, we're talking about things over that 10% usually.
Very good.
Yeah.
And then the other thing that is important for people to have is an emergency fund.
Mm-hmm.
Now, you never want to, in my opinion at least, you never want to take your bank account down to zero if you can help it. You should always have at least something in there for those, day-to-day emergencies. But another kind of way to look at it is kind of a longer-term emergency fund, and 3 to 6 months of expenses is kind of the guidelines a lot of people have used for that emergency fund.
Yeah. So you have your expenses covered. You're trying to match your employer. You've paid off some of your debt. Your focus should be on now building that emergency fund so that when you do have a car breakdown or you have something break in your house, that you can cover it without having to put it on your credit card or taking a loan. You can go ahead and just pay for that out of your emergency fund, which is what that is for. The big quote that everyone, or the big stat that everyone has is like a majority of Americans can't come up with $1,000 emergency fund in the United States. I think a lot of people rely on credit cards as an emergency fund. And I would not recommend that.
No, that can get you in trouble in a big hurry. And then, of course, the other thing with a 3 to 6 month emergency fund is if you get into a situation where you're laid off or maybe you get injured and you can't work for a while, that's another thing that you fall back on, is that 3 to 6 months of expenses to keep you out of debt while you're recovering or while you're looking for that next place of employment. Yeah.
So with the emergency fund, set a goal for yourself. Okay, let's try to get this to 1,000 in the next couple months, then to 2,000. It can be small. You're not trying to put everything on there all at once. But, if you can automate the process, from your paycheck, okay, I'm going to put $50 into the emergency fund every month, $25 into the emergency fund every month. Just taking that, taking the thinking away from it. So when you get your paycheck, have some sort of system set up with your bank to where maybe it goes, you have $25, $50 go into that savings account automatically. So never even have to worry about it going into your checking. That's an easy way to try to start getting that emergency fund created.
And one of the things that's great about saving for an emergency fund is if something does come up where maybe that particular month you can't put money in, or maybe you got to pull just a little bit out, you can shut it down for a little while, focus on that, and then come back and start refunding that emergency fund again.
Yeah, and anything in the process, if there's something, like we're going to talk about these other things in this process, if there's something going on that comes up, you can always change. You can always
revert
readjust.
Back.
Yeah,
exactly.
Go back and be like, okay, what are my priorities? All right, if I can get these first 3 covered, that's important. So don't think of this as I have to do all these things right now, or that it's always going to be like that. There's going to be change, in everyone's process and everyone's life. There's going to be, different paths we take.
Sure. So a person has got their expenses covered, their groceries, all of that. They're getting their employer match. They've tackled their high interest debt, they've got that paid off, and they've got their emergency fund fully funded. Now you're starting to get into that wealth building phase.
Yep.
What's the next step for folks with any extra they have from their paycheck after those steps are taken?
So, in our opinion, or my opinion, I would say the next step would be looking into starting funding a Roth IRA. There are contribution limits, so maybe find out, how much can I give each month from my paycheck and try to get to those limits each year. If you can try to max out that Roth IRA every year, which right now is $7,000 without the catch-up provision. If you're 50 or older, you can put $8,000, I believe, this year. But trying to max that out each year, those contributions grow tax-free.
Okay. So you've brought up an IRA.
Yeah.
And obviously there are Roth versus traditional, and we've talked about that in the past, but you recommend Roth. There's lots of power to the Roth. The other thing people might consider would be if they're already getting an employer match, that you can also put extra into the 401k at work. And a lot of them have Roth options as well.
Yeah, you can always, another way to think about it is like, I got to my match. Okay, now can I get to the max that I can give in my 401k for the year? And so, that's an incredible thing if you're able to do that, especially if they have a Roth option. If they don't have a Roth option, which most people do, but if you don't, maybe that is the time we're like, okay, well, I'm going to focus on the Roth 401k first before I max my regular 401k.
Yeah, and that's kind of how just my own personal belief, I've always thought, okay, I'm going to get the match. Then I'm going to go over to the Roth IRA that's outside of the workplace. And I like that because I had a lot more options of where I invested, because you can go with, an advisor, you can go with, something like a Vanguard or a Fidelity. Any of these options are out there, and there's just hundreds and hundreds of different funds that you can invest in, whatever is right for you. Whereas your 401k at work might be limited to just a handful of funds. So, like I said, my personal view on it has always been get the match, max out the Roth IRA, and then go back to the workplace if I had any extra after that.
Yeah, I think that's a great way to think about it. Going along with talking about, the money in, we talk about, getting that match in your 401k. Make sure that when you are, your 401k is rolling, make sure that it's being allocated correctly. Make sure that you're in there and you're looking at, if you're a 25-year-old with this 401k, make sure that you're not, that you're being somewhat aggressive, that you are looking to grow that money and make sure that's what, your goals are aligned with what you want. Because sometimes people they just put money into there and they're like, okay, cool, and they don't do anything with their asset allocation, which you should be able to control your asset allocation in the 401k, and your company should give you options for that. So make sure to know that you should have options. And if you're not sure about those options, look at how much they're costing you, look at their performance over so many years, look at some of those things to see what they fit your goal. If you're not sure, talk to somebody. Look, for like Bob and I are, Bob's a CFP, I'm working towards mine. Look for those credentials for people that can give you advice, that they're just looking out for your best interest. So
what a great segue. It would be, it could be you and Bob that they want to reach out to, and bobschwartzfinancial.com would be a great place to reach out through. So we've talked a little bit about Roths, but one of the things that has intrigued me, and it's kind of more of a recent thing, as far as investing goes, HSAs have become very popular. Health savings account is what an HSA is. Maybe you can talk a little bit about why that's such a special category and why that's also a good vehicle for investing.
Yeah, HSAs are, they're a triple tax advantaged account. Which makes them amazing. They're an awesome opportunity, but not everyone has the ability to invest in one. You have to be you have to have a high deductible health plan to have an HSA.
Right, and that's per the IRS. The IRS says if you have a high deductible health plan, you can invest in an HSA. I don't have an HSA because I've never had a high deductible health plan.
Yep.
So I can't invest in the HSA. But you mentioned triple tax advantage, and let's talk about that because it's pre-tax money that's going in. So you're not paying any taxes on anything that's invested into an HSA.
Yep.
It grows tax-free, meaning you're not paying any taxes on any of the growth.
Yep.
And it's not taxed coming out as long as you're using it for a covered benefit, something to do with medical.
Yep. And there's, look into what all HSAs cover. They cover a lot of things.
Yeah. In fact, I'm going to put you on the spot here, but I believe that you can even use an HSA to pay your Medicare premiums. Is that accurate? Or your long-term care premiums?
Yes, there are definitely some. HSAs have a lot of options with long-term care and Medicare, I know. As you get older, if you can start contributing to HSA, it could have a big impact, especially if you don't have to touch it for a long time and, later in life.
And that's the other thing that's really important about the HSAs. You can start investing, obviously, at any age, as long as you have that eligibility, but you don't have to, you go to the doctor, you get a bill, you don't have to submit that bill right away. You can literally set on that bill and just keep a copy of it and never turn that in till 20, 30, 40 years later. You can, and all that time, that money is just growing, just because you can invest it just like an IRA. But then when it's time for you to need the money, you want to start withdrawing that, you can pull out medical bills from years and years in the past, and it's a great way to save.
Yeah, it's a powerful tool, and it's funny if you go onto websites. I was looking for a treadmill recently, and it was like HSA available purchase. I'm like, wow, it's not just your doctor's visits that you can pay for,
right?
Especially another great thing about that is it can pay, for I don't know, my HSA paid for my daughter's, breathing machine, things like that, or, medical equipment if your children or a family member has something, that it can really be a useful tool. So
yeah, it is definitely powerful. There are limits to how much you can put in there every year, but really it's a very powerful investing tool that is becoming more and more popular, especially as more and more folks look towards those high deductible health plans.
Yep.
And that's another area that I think is important for young people to look at, because high deductible health plans are, as you get to be my age and we start going to the doctor a bit more and we start to have, more and more medical issues, those high deductible health plans might not be the best situation for your family.
No.
But when you're younger, in your 20s and your 30s, and you don't, normally have a lot of medical issues, you're healthiest most of the time in those ages, those high deductible health plans are really something to look at, I think.
Yeah, especially with the cost of insurance right now.
Absolutely.
I feel like when you're in your 20s and 30s, a high deductible, evaluating every year, first of all, hey, how many times did I go to the doctor? Would it be worth it for me to have a high, is it worth it for me to have just a high deductible plan instead? So, there's a lot of companies that offer a high deductible plan for free. And, I would take advantage of that if you're in your 20s and 30s and you're in good health, for sure.
Great. Yep, I agree. So we've talked about, what do we do if we have money left over after all the bills are taken care of, and we've kind of talked about that. What's kind of the next step then? Because you've kind of allocated all the money. Let's maybe start to talk about what are the benefits now that we're going to start to see from all of that.
Yeah, so we've went through. We've paid our liabilities. We've taken care of our emergency fund. We've maxed out or got up to our employer match. We've started our Roth IRA or our HSA if we've had that option. The next option really, and we kind of already talked about this, but making sure you're maxing out your retirement, making sure that if you don't have that Roth 401k at work, you're matching, trying to get up to your contribution limits to your 401k. But the next big thing, and what Joe's alluding to, is the hyper accumulation phase. You're really starting to build wealth
And let your money work for you.
But you're really starting to build your wealth. And a lot of that time, we're looking at like maybe a taxable brokerage account, a joint tenancy account, or a single account if you're a single person, to where it is a taxable account, but you're using it to build wealth.
And let's talk a little bit about the brokerage accounts, the taxable accounts. That is money that's post-tax, so you've already paid the tax on your income. Mm-hmm. So this is post-tax money. You can invest in, EFTs, individual stocks. You can put it into bonds. I mean, really, you can put it into anything.
Yep.
And it does get taxed differently, though. If it's interest, like if you have it in bonds, or you're just getting interest, then you're going to pay just normal income tax on it.
Yep.
But there is the option for some long-term capital gains inside those, and we won't get into the details on that because that could be a whole show in itself, but there are some tax advantages to having money in one of those brokerage accounts.
Yeah. Brokerage accounts are, a great way to build, after you've done all those things, that you can build wealth with. The one thing you want to be aware of, is this isn't in our opinion, is not the account you want to be, day trading in.
Right.
Or we don't think that's a good idea regardless, for most people. But, short-term capital gains are going to cost you a lot of money. So
right.
You want to be aware of, this is where you can, let money build. Think of long-term investments or fixed income. Those are all, really great opportunities in your brokerage account that we're trying not to trigger these short-term capital gains.
Sure.
We're holding things over a year. The interest in those accounts is what we're really looking at, trying to build wealth over time, using equity, ETFs, those things. Yeah.
One of the things that I like about a brokerage account is the fact that the money is liquid. So when you put money into an
Yep.
IRA or you put money into a 401k, generally, and there are some, there's some, I mean, there's some instances where this isn't the rule, but generally you have to be 59 and a half years old before you can pull that money out without being penalized.
Yep.
In a brokerage account, there's no penalties for that. It's totally accessible. You put money in, you can take money out the very next day if you need to.
Yeah, and if you have a great gain and you want to, trim and to pay that tax and get some of that money back and pay for something, that's totally up to you. Some people think of the brokerage account as like, can never touch the money. No, I mean, that's what it's for. You can use it. Just understand you're probably going to have to pay some sort of tax when you get it out. But that is as Bob always says, that is a privilege because that means you made money.
Right. Absolutely. It's so much better to pay taxes on money you made
Yep.
than get a tax deduction on money you might have lost. So.
Yep, exactly.
And we don't want to get into the taxing part of that. It gets a little complicated, but we'll give an example. Let's say that you bought some stock. Let's say it was Apple.
Yep.
And you bought some stock, and we're not saying you should buy Apple stock. It's
Yep.
just an example.
Yeah.
But you bought Apple maybe 10 years ago, and you decide, I'm going to cash in on that, and I'm going to sell that stock today. You're going to pay long-term capital gains on the difference on the revenue that you made. So whatever you bought it for and sold it at, the difference there is what you're going to pay long-term capital gains. And that is not the same as paying income tax. It is a different rate. It varies based on your income that particular year and how much, but it is considerably lower than the income tax rate.
Yeah, and a lot of the taxing with accounts can be confusing and hard for people. Make sure that you're working with, a tax specialist, accountant, a financial planner that can help you, if you have questions about that, ask. And because I think that's hard for some people to wrap their head around sometimes, and it keeps them away from investing.
Absolutely, and it can be complicated, that is for sure.
Yeah.
Another area, if folks have children or maybe grandchildren, a special niece or nephew, another area where they can save money is a 529 plan. We've talked about 529s in the past, but what are 529s and why are they so important?
They're a great way to pay for college, help pay for college for, someone, a loved one in your life. It doesn't have to be, it could be your grandkid, your kid, your niece, whatever it is, the person you're giving money to, and you're able to take a state tax deduction.
A state tax deduction.
Yep.
That's the important thing to think of. In Kansas, we have a state tax deduction for 529 contributions.
Yep.
There is no federal tax deduction, though. This is all post-tax, meaning you've already paid tax on it, and you're not going to get any kind of a deduction on your federal tax return. But that's an important thing to think about, and we'll talk about why in just a second.
Yeah.
But go ahead.
So those are you get a state tax deduction, which is amazing, and then that money gets to grow tax-free, and it comes out as long as it is used for educational purposes. For their college expenses, they get to take it out tax-free.
Yeah, and once again, that's a very broad category.
Yeah.
There's a lot of things that count. If you need a computer for, your education, your college education, you can use it for that. It's a great, powerful tool, just like for all the reasons you just said. So one of the changes that's happened in the last several years, which I think has made it even a more powerful tool, is they've given it some extra flexibility now.
Yep.
I know that from a personal standpoint, and then I've also heard from others, a lot of people were concerned about putting a lot of money into 529s because, well, what happens if my child doesn't go to college? Mm-hmm. What happens if they get a lot of scholarships and don't need all that money? What happens then? Because if you take that money out and it's not used for education, there's actually a penalty on it. So a lot of people, were very careful on how much they invested. Yeah. One of the things that's changed over the last couple of years with Secure 2.0 is now you can actually convert that investment, the 529, into a Roth. There's a lot of things that have to, like the 529 has to be 15 years old before you can convert it. It's a $35,000 max lifetime conversion amount, but that's at its current $7,000 a year limit on Roth IRAs. That's 5 years worth of contributions. Mm-hmm. And when you convert it, you can only convert up to the annual limit, per year. So you might have to do it over time. But I think that has made the 529 even that much more popular.
Yeah, I 100% agree. And there, that people get concerned about the 529s, but always remember too, you have that new option. We talked about rolling into the Roth, which we've talked about is an incredible opportunity. But also you can always roll it down to, you can change the beneficiary to, another child that maybe didn't get all the scholarships or
maybe you want to go back to school and you can change yourself to the beneficiary.
So there's other ways, but that is an amazing thing. Another thing, right now we're talking about prepaid expenses, college. The other things to think about are huge things coming up in your life. Do you and your spouse or do you and your family have a huge vacation that you really want to go on in 3 years for a 20th wedding anniversary, or that you have multiple daughters and they're going to be paying for certain weddings, or you're going to want to buy this car in the next 2 years? That's where you want to look at these prepaid future expenses. You want to start looking at, okay, how am I going to save up for this, and start I don't know, start having a plan for those expenses, upcoming expenses. Yeah.
Yeah, let's talk about an automobile.
Yeah.
So if you know that 2 to 3 years down the road that you want to buy a new vehicle, it is so much better to set aside a little bit now, let that money gather interest for you than waiting until it's time to buy and then borrowing money and having a car payment and paying interest to somebody else.
Exactly. Yeah. If you can create, like a little bit of even if it's in your brokerage account, you set aside money market and you're like, okay, I'm going to put $1,000 in the money market, every month or whatever. And eventually, that money's gaining interest while you're saving up for, your vacation, your car, whatever it is, and you're at least making money out of that instead of, putting on a credit card or going into debt. We want to pay for these things with money that we have.
Absolutely. Makes lots of sense.
Yeah.
And then let's talk about low interest debt. So you kind of mentioned it already, the mortgage, maybe you've got maybe you've done home improvements and you've got a second mortgage, those kind of things that are low interest.
Yep.
Those are kind of the last thing in your opinion. Is that what you would say?
Yeah. Low interest debt. There's a lot of people out there that have a mortgage at 2, 3, 4%. And, if your investments or your money can be better suited elsewhere, if they're making more than that, we'd really recommend you not pay that off right now and focus on the investment side of things and keep building wealth that's doing better than that 4% and just pay out that off over time.
Yeah, it's going to be, especially in today's interest rate environment, you're not going to find any interest rate less than 4 to 5% at this point. To stay locked in at that rate, especially since most people have it over a 30-year period.
Yep.
That's really a pretty powerful tool. And now there's the flip side of that too.
Yeah.
Debt represents risk, and there's always risk involved with having debt. So there's definitely something to be said about having a paid off home.
Yeah.
But generally, you can do better with your money, even if you've just got it in a high interest savings account, getting 4.5%, and your mortgage is 3%. Well, you're already ahead.
Yeah, and money can be so different, like between people psychologically. If you can't handle having debt, like that really, like that bothers you to no end. This might be higher on your priority list. And I don't think there's anything wrong with paying off debt if that's what you want to do, but if we're talking about building wealth, the best strategy probably would be to not, keep investing and keeping that low interest debt where your money can be used better elsewhere. But like I said, everyone's situation is different. Some people want that house paid off, that car paid off as soon as they possibly can. And in the long run, are you going to probably, maybe you lost a little bit of money here and there, but, you're going to be able to hyper accumulate, right after because you're not paying any debt. So, I don't have any problem with people that say they want to do those things. It's not necessarily maybe the best financial decision. Like it's not the best return they could possibly get, but it's not something that's necessarily bad at all.
It could be the best decision for their family,
Yes.
even if it's maybe not on paper the best financial decision.
Exactly.
Absolutely.
And there's lots of those decisions that people make in life that maybe they don't make the most sense, but make sense for those people.
No, it makes sense. Well, that kind of talk, we've kind of gone through, just a typical paycheck. What are some of the priorities that maybe you want to look at? Really, I think that the overarching, I don't know. I'm at a loss for words right now, but it's really just to have a plan.
Yep.
I mean, that is the most important thing of all. Have a plan. Plan, I think, could equal budget. Plan, budget, kind of interchangeable here. Have a plan, have a budget.
Yeah.
Let that money work for you.
The one thing I would add is just, and I've read this in a couple of books now, and I've tried to do this a little bit on for myself, but automate the process. Like have your paycheck and have your bank set up to where money goes, without you having to do anything. Every month, your money goes to the certain places. That little money goes in your emergency fund. The other goes into your retirement. The other goes in the broker. Whatever it is, it automatically does it. So you don't have to think about it at all. If you can automate the process, that makes things so much easier than you having to go in and be like, okay, I need to put $50 here, but I don't really want to this month. Take that decision making away and just automate the process. And if you need to change it, change it.
Sounds good. Always good advice, Mark. If you want more information on if you were looking to start working with a financial advisor, bobschwartzfinancial.com. That's a great place to go. Bob, who's not with us today, and Mark, they're standing by, ready to help out. So with that, we'll wrap this episode up. Thanks for joining us.